sometimes the focus is tax mitigation. And it has to be, because the tax rates sometimes are confiscatory, especially when we're talking estate taxes. But even capital gain taxes can be terrible in transition, depending on how you're doing it. So this is interesting because at least I found it very interesting. This person's a friend of mine, and I'm not going to mention any characteristics of his business, but his dad is a very successful businessman and has multiple businesses and real estate projects and companies that provide various services. And there's one particular company that was very successful, although it was still in sort of its infant stage, and it was just one of his many assets. So back in the early 2000s, the exemption for estate taxes, the lifetime exemption, was $1 million per spouse. And this gentleman was probably at 20 or 25 million in assets. So he was very concerned about the tax rate. And back then it was 50% up to 55, then back down to 50. It was terrible. Plus, in this particular state, they also have their own inheritance tax, state tax, that is between 10 and 16%. So it's just devastating. So he was right to be worried about it. But so what his solution was in this particular situation, he had this operating entity, this nice little company, making money. One son was working on it full time, and then he had two other sons. And so he left an equal interest in this company to all three. Well, the one son who was working there over the next 15, 16 years grew this company. Very dynamic, very conscientious man, wonderful guy, and a great operator. Made very good business decisions, all the while growing this now value in his estate and in his brother's. And I met with him maybe 4 years ago, and he wanted to buy his brothers out because he has additional plans to grow, which is pretty typical of a person who's dynamic and interested and good at their business. And so he knew that he needed to buy them out. Otherwise, he's going to continue to only harvest 1/3 of the value of his efforts. And this goes to the core of having taxes drive your planning. And it goes to the core of family continuity planning because it creates a rub between the person running the business and the people who are the passive owners. The passive owners' objectives, of course, being passive income. And the person running the operation, his objective, of course, is company growth. And those two objectives are diametrically opposed. Because if you're going to distribute income and profits, you're not going to have that capital to invest in the company and grow it. So there became this rub. So my client wanted to grow the company, wanted to buy his two brothers out. Brothers said, fine, give us a valuation. Fair market valuation will be fine. We'll do it. So he was stoked. And spent $15,000 on a valuation, his own money, to get that to happen. The one brother agreed to the valuation. The other brother said, I want 175% of that valuation because it's not fair that company is going to grow or we're not going to get a part of that. Now, that was a deal breaker for my client. And it was terrible for him. And he still is in partnership 4 years later with his brothers. The company is growing. And he is an employee, not a business owner any longer. He basically works for his brothers. And that relationship with those brothers is very strained. So when we talk about, family continuity planning as part of your strategy, it's the underlying strategy. Because that man who did that gift is a good man, surely well-intentioned. And avoiding taxes is a good intention, by the way. That's a good thing. But what he did without knowing it was create a situation that was untenable for any of his sons. It wasn't good for any of them. And the relationship is sullied.